Can protective puts protect against a sudden stock market crash? Imagine having a safety net while walking a tightrope. That's what protective puts aim to do for your investments. They act like insurance for your stocks, especially during sudden drops. When you buy a protective put, you own the stock and also purchase a put option. This put gives you the right to sell your stock at a specific price, called the strike price. If the stock price falls below that strike, the put option gains value and helps offset your losses. This strategy is popular among investors who want to stay invested long-term but worry about quick market crashes or sharp declines. The maximum loss with a protective put is the difference between what you paid for the stock and the strike price, plus the cost of the put premium. If the stock rises, you keep all the upside minus what you paid for the put. So, it's like having a safety floor while still enjoying potential gains. But it's not a perfect shield. The cost of buying these put options can be high, especially when markets are volatile. That premium can eat into your returns if the market doesn't drop. Also, options lose value as they near expiration, which is called time decay. If the market doesn't fall quickly, your protection can weaken over time, meaning you might need to buy new puts to stay protected. Volatility plays a big role here. When markets are stressed, options tend to cost more because traders expect bigger moves. If volatility drops, the price of your puts can go down, reducing their protective value. Timing is also key. If a crash happens outside the period when you hold the puts, you won't be protected. Remember, protective puts help limit losses but don't eliminate all risk. During long or sideways markets, the cost of maintaining these options might outweigh the benefits. It's important to weigh the premium costs and the likelihood of a crash happening during your holding period. Think of protective puts as a temporary insurance policy rather than a permanent fix. In the end, they can help shield you from sudden market drops by setting a floor on your losses. But their effectiveness depends on how much you pay for the options when the crash occurs and how actively you manage your positions. They provide downside protection while still allowing you to participate in gains, but they do requiring careful monitoring and cost consideration.